In this video, we'll discuss the Bank of Canada's green light to homebuyers. That's right, no more rate hikes. For now, it's a real estate buyer's dream come true. Stick with us to determine if it's the right time for you to get in the game. Finally, some good news. We
Yeah,
just
about
got word
time.
a couple days ago, right? January 25th, Tiff Macklem came out, chairperson of the Bank of Canada, and announced one more rate hike of a quarter of a percentage point, and that might be time for a pause. They got to see the lay of the land and see how the effective interest rates will push through the rest of the economy, and then make a decision in the second half of 2023 whether or not additional rate hikes might be warranted. So we've come a long way, right, Dev? I mean, prime rate now has climbed to 6.7 as a result of this most recent hike. And now there's a huge discretion between variable rates and fixed rates, complicating the decision for anybody with an existing variable rate mortgage and anybody looking to make a decision around what product to take if they're choosing to buy a home right now. Let's tackle kind of the discussion between these two scenarios.
Yeah, it's certainly interesting. I mean, on a personal note, I'm certainly happy that Bank of Canada has decided not to pause. It'll certainly help a lot of other people with variable rate mortgages as well, especially if we remove that uncertainty of every couple of months, waiting with bated breath as to whether or not that prime rate is going to continue to go up. If we do see rates kind of sit around this level, variables are, about 1.25% higher than the equivalent 5-year fixed offering, which is relatively unprecedented, right? You've got a substantial gap between the two. Typically, variables are about 20, 25, 15, 25 basis points cheaper simply because you're being given a discount or better rate offerings for taking a bit of risk that comes with the variable rates.
Yeah.
Complete opposite story today. So definitely a more unusual conversation for people who are looking to buy a home, what to do with interest rates.
Reminds me of a scenario actually from roughly late 2020, 2021, where if somebody wanted to get more borrowing capacity, because of the spread between variable and fixed rates, they often chose a variable rate to give them that additional borrowing capacity so they could buy the home they're looking to buy.
Without a
Now
doubt.
it actually, right? And now it actually goes the other way. The variable rate is so much more meaningfully higher. It constrains somebody's borrowing capacity if they're looking to buy, further complicating the decision of variable versus fixed. And
Yeah.
we understand there's a lot of consideration about taking a fixed rate mortgage. You'd hate to think that some people might overlook that, especially with the volatility that we've had over the last year with variable rate products.
Yeah, it's by far the worst part about the stress test. The stress test doesn't really take into consideration which product makes the most sense for you. It's simply taking a look at the mortgage rate, adding 2%, and can you afford it? Well, for variables, that makes sense. You want to make sure that you've got some capacity to manage that. But at
Mm-hmm.
these current rates, a variable rate product might be a better option if you're willing to take some risk to the upside over the short term, whether that's you're confident in your income, you're looking to make changes over the short term. But the expectation, at least from the bond market, is that we see roughly 200 basis points worth of cuts. At least that's what's being priced in sometime over the next 24 months. So if you're looking at a 2-year fixed, which is still in the mid to high fives versus a variable sitting around 6 to 6.25, if you're expecting that kind of, that number of cuts, that would put you well below that 2-year fixed kind of timeline. So
Mm-hmm.
it's a tricky situation to try and you are guessing, you are speculating a little bit on the movement of
Yeah.
rates, but you are forced into taking products that aren't necessarily aligned with what you're wanting to do if it comes down to what can you borrow. If
Yeah.
the 5-year fixed qualifies at 4.75 plus 2% versus 6% plus 2%, huge difference to borrowing power.
No doubt. Yeah, and people have to be conscious when you're trying to make that decision. What's the borrower profile? Are you a single person trying to buy a home? Are you buying at the high end of your range? Are you two people with a ton of breathing room based on the income you're qualifying? If rates become a little bit more volatile than what the Bank of Canada is predicting today, do you have the capacity to absorb those slightly higher payments? So what does your risk profile look like and what product is justified around that? So that obviously alludes to what somebody who's taken out a new mortgage product might consider doing. How about for anybody sitting in an existing variable rate mortgage? They've seen fixed rates come down. Fixed payments, if they choose to convert from variable to fixed, will be materially lower than what they're currently paying on their variable rate mortgage. Why doesn't everyone just switch?
What we talk about this all the time with our own mortgages. If the bond market's pricing in what they would call immaculate disinflation, which is effectively a straight or a perfect set of scenarios that lead to inflation back at that 2 to 3% range over the next 12 to 18 months, then the expectation is rates can move back to a more neutral rate territory. And that does directly impact variable rate mortgages. And the expectation, as I mentioned, is that 200 basis points in cuts. 200 basis points takes you below the current even best 3-year fixed rate out there right now.
Mhm.
So to lock in at these rates for, let's say, a 3-year term potentially puts you at risk of overpaying over the next 3 years if the bond market is right and we do see that disinflation
Yeah.
continue and start to go away.
Well, in line with that, I mean, I know I asked the question, but frankly, I do have my own opinion on it. And it's certainly not that everybody should blindly switch from variable to fixed despite the discounted rate. Anybody who took a variable rate product in 2020, 2021, you got to understand there's two components to your rate. There's prime, which today has climbed all the way to 6.7. And then the second component is your discount to prime. At that time, the discount to prime on average hovered somewhere in the neighborhood of 1.2%. So at a rate of 6.7, prime minus 1.2 would bring you to 5.5 today. So that 5.5 rate is actually materially closer to the 3, 4, and 5-year fixed terms that are available today. Often pretty closely in line depending on the lender, but probably a gap of like 50 basis points. The market's pricing in materially more than 50 basis points of cuts. In the US, where we get more detailed data, they're actually pricing roughly 200 basis points of cuts between now and mid 2024. Sorry, between now and early 2025. In saying that, who should still consider the switch despite that? Well, if you realize that should the Bank of Canada be incorrect, and in fact, rates continue to rise from here, if it'll push you to a point where you're defaulting on your mortgage, heavily accumulating unsecured debt, you should probably strongly consider the switch to a fixed rate mortgage, give yourself that payment stability. That would make a lot of sense based on your risk profile. But if you're somebody with a ton of borrowing capacity, the cash flow from your income after expenses is significant, you've been able to continue setting money aside every month despite rising interest rates, you might consider staying in that variable. Your variable is a way more competitive product than the variable rates that are available in today's market. Dev, what are you seeing out there? What's the average discount on uninsured mortgages for variable rate products right now?
Yeah, you're between prime minus 25 and prime minus 40.
Yeah.
They can get pushed down a little bit further on really big mortgages, but I mean, there's such a staggering difference between a lot of people that were securing variable rates in 2020, 2021, even early parts of 2022. You're 60, 70, sometimes 80 basis points in difference. That discount's enormous. And those were priced at a time when there was a general expectation that prime was going to rise. No one knew how much, and inflation, really took off in the spring, which led to that massive amount of rate hikes we have seen. But the pricing today would suggest that there's we're getting close to where the bond market's actually suggesting some sort of movement downwards, and that you typically see pricing of variable rate mortgages reflect that as the discounts shrink towards prime. Banks aren't willing to give huge discounts off a rate they are expecting to move down over time. There's a million different considerations to
Yeah.
other factors of pricing, but it's a good way to kind of take a look at the pricing of variable rates and see how and what the banks are pricing their mortgages with.
We've talked a little bit about what the considerations are if you're looking to make a potential purchase into the market, or if you're considering a switch from a variable rate to a fixed mortgage. Let's transition a little bit. Interest rates are the most powerful lever that's available specifically to the Bank of Canada and how they affect monetary policy to impact both the economy and the housing market. This like very, very general rule of thumb is for every 1% change in interest rates, you'll see a 10% change in asset prices. Dev, you look at the stock market over the last few days, particularly over the last week, ratcheted right up. The moment we get any indication of a tapering or a pause, stock market takes off immediately. It can accelerate so much faster than the housing market, but we're seeing a lot of bubbling enthusiasm for housing coming up in January. What could the effect of these rate cuts potentially have on the economy and housing?
Yeah, it's certainly not the time to FOMO into your next house purchase, but and it's funny watching the stock market do what it does, because it prices in forward expectations very quickly. You've got trillions of dollars being circulated in the equity markets, and and yeah, you gotta love that volatility. But The housing market, yeah, it's going to move a little bit slower. You're right. We're definitely seeing an increase of applications. You're hearing more and more stories about the dreaded, offer nights coming back for listings. Supply and most professionals in real estate will tell you supply is still at super all-time lows. Rents are still high. There's still a ton of demand for people who want to purchase homes for themselves to live in. That is something that we don't have enough of in and around the GTA specifically. That's where we both are. So it doesn't surprise me to see that while supply remains super low, bubbling demand is going to come up every time we get a little bit more certainty around interest rates,
Hmm.
and especially with projections towards a slowing of either rate hikes or potentially even rate cuts. People are
Hmm.
going to start to apply that same kind of forward looking logic to a home purchase. Well, hey, I may not be able to comfortably afford this payment, but if rates drop by 2% over the next 2 years, I would be fine. Can I manage over that time frame? And for a lot of people who have been on the sidelines for the last 6, 8, 12 months, uh, you know, there is some impatience to it. Other people have to make a purchase.
That's right.
I'm going to have to make a home purchase probably towards the end of this year. So
Hmm.
for me, it's less about speculating on the market. It's more just what do I need to do.
Yeah,
So
it's real
that
life.
yeah, it's real life exactly. There's only so much time you can delay things before you have to make changes. We've seen a pretty
Yeah.
unique scenario over the last 6 months where market activity disappeared broadly because the massive uncertainty around interest rates. When you start to get certainty, that buyer sentiment comes back.
Yeah. Yeah. There's a material effect when rates and yields start to fall. Because what happens is it opens up borrowing capacity. And that's not just borrowing capacity for anybody looking to buy a home, but that's also for anybody looking to potentially tap equity from an existing property towards the purchase of another property, including potentially secondary property or rental property. It also affords loosening conditions for anybody who might be looking to consolidate unsecured debt back into their mortgage to reduce their total cost of borrowing. On the one hand, these are positive things, but this sort of quick loosening of financial conditions can actually have a pretty negative effect on tapering inflation. And history tells us that when you drop rates too quickly, you tend to get a quick bounce back in inflation that can often be much worse than that original bout that we dealt with. So I'm going to offer a very unpopular opinion. If you want to give me grief, feel free to do it in the comments, but this is truly how I feel. We have to be very conscious of the messaging moving forward from the Bank of Canada and the actions themselves, because I really think there's this irrational exuberance just sitting below the surface, waiting to make some irrational choices in the near term. And I think too much loosening of financial conditions can really set us back, can create further affordability issues. So I do anticipate these rates are going to remain where they are for at least the next 4 to 6 months. We'll see what the second half has in store as economic conditions continue to kind of deteriorate a little bit. And we're going to talk a little bit more about that as well.
Yeah, it's it's one of the things that the Bank of Canada has already made one mistake with forward guidance and saying that rates were
To
going to stay low for a long
put
period
it
of time.
lightly.
Yeah. So, yeah, I think they are conscious of making that mistake again. I was
Mm.
surprised really by their messaging that came out, on Wednesday when they did actually announce what their rate policy change. And they did issue forward guidance and saying that they wanted to pause here, at least for now, until the
Yeah.
data starts to support something else. And that kind of messaging almost didn't need to be there. We've seen some obvious positive reactions to the market. We know that the stocks loved that kind of messaging.
Crypto
And
stocks. Yeah. All
yeah,
risk
and
assets.
exactly all risk assets. So it was something that wasn't necessarily needed at that time, and we really want to be careful with how much faster, or how
Yeah.
fast they do bring those rates down. It's setting up a perfect repeat of the 70s and 80s. We haven't really addressed any of the material, I guess, headline inflation drivers. Oil, copper starting to climb back up. Natural gas is doing its thing, but there's
Well,
still enough to support a potential, reacceleration of inflation, especially when a lot of what goes into, even core inflation, all the household expenses, mortgage payments or shelter costs, Yeah, the more they raise rates, it's a nice little circular formula. As
Yeah.
they raise rates, it bakes in that higher input cost, which means that we're creating our own inflation to at some
Yeah.
point. So it becomes a vicious circle.
Dev, I mean, clearly, we just talked about the potential risks associated with loosening financial conditions too much, but there's a reason that they're pausing. And I think it's important to have that context for anybody who's looking to make a decision of staying in variable, converting to fixed, or what product choice they want to make moving forward. I'd like to tap into that a little bit.
Sure.
We've got headline inflation, we've got core inflation. And core inflation specifically strips out food and energy. In both headline and core inflation, and in producer prices and raw materials over the last 6 months, particularly since the peak in June, we've seen a significant decline in every one of those readings. Core inflation was falling a little bit slower, specifically because of service-based inflation. Even that has recently fallen. And over the last 3 months, if you look at the cumulative 3 months of headline and core inflation, and then you annualize that figure, we're below 4%. And specifically in the case of headline, we're actually returning to trend, which would be 2%. So clearly that's some of the catalyst for the Bank of Canada's decision to pause. We understand that high rates are now only affecting a relatively small portion of the population, anybody who had a variable rate mortgage. But I don't know if people understand, every year, 20% of the mortgage book comes up for maturity, roughly. Now all those people are going to start to absorb rates. It's going to be meaningful.
Yeah, well, yeah, you're certainly going to notice a change in household expenses. So for anyone who's been managing well because they're locked into nice low mortgage rates, or perhaps they've managed to keep their debt to income ratios in balance, then we will see a percentage of those borrowers kind of walk into a new reality this year if they are hitting maturity. A lot of those interest rates are not overly attractive in terms of renewal
Mm-hmm.
offers from the banks. That's because the banks know it's harder to qualify at these rates. The stress test is both a friend to buyers to protect them against rising interest rates, but it can also really limit their borrowing power, especially at times of renewals. If rates have risen faster than income have, then it creates a scenario where you're effectively trapped with your current bank and they're able to offer you what they want.
Mm-hmm.
So yeah, you're definitely gonna notice an impact to overall household spending as the year goes on, and for as long as rates stay at these levels, right? We've
Yeah.
felt the pain over the last year, but we've really felt it in incremental increases as the bank moves those rates up. Now we're floating all debt at these higher rates, and that's going to continue likely for the majority of this year. So as every month goes on, consumer sentiment and overall spending ability will continue to decrease, and that's where have a lot of people calling for a recession sometime this year. You can only manage growth for so long at these kinds of interest rates. The bank is
Yeah.
in contractionary rate policy, so they are putting the brakes on the economy to try and slow it down. And the longer they keep it there, the greater the percentage risk comes that we hit some sort of hard landing or a recession, as they would call it.
And just a quick note, I was thinking about this as we were having the discussion. Anybody that is coming up for maturity, don't forget, you're going to get these attractive offers at renewal. That's all good and well. But if you're concerned about how much your payment's going to increase and how that's going to affect your household budget during this term where you're going to have higher rates, you may consider extending your amortization. Sure, priorities to pay down your mortgage as quick as possible, get rid of the debt. I have no qualms about that. It's the right thing to do in principle. But if you feel that your budget's going to be out of whack and you're going to accumulate unsecured debt, use this time to increase that amortization. Don't let that opportunity pass you by. Same to be said if you have some unsecured debt. Use this opportunity to consolidate it, roll it into the mortgage, pay it down more quickly, but at a much lower cost of borrowing. I want to quickly move on. Deb, you were talking about energy. Sorry, go ahead. Go ahead.
I was just gonna
Yeah.
say, and
Yeah.
make sure that you shop around.
No
make
doubt.
make the calls. Don't just sign off with your current lender. Don't take those early renewal offers if you're getting rates that are substantially above your current interest rate. Shop around, talk to a professional who can help you go through all the different options available to you, and make sure that as you're mentioning, if you need to do things like re-extend amortization, it's way better to re-extend amortization than to start accumulating unsecured debt at much higher rates, especially in
Yeah.
scenarios where you want to be confident with managing finances at these rates for as long as the
Yeah.
rates stay in this territory.
We'll move on. Deb, you were talking about energy prices earlier. So oil, copper, lumber, and particularly the war in Ukraine and how it affects other input costs. these are some of the factors we're going to be watching to make sure that inflation doesn't sort of ratchet back up and change the trajectory that the Bank of Canada is now headed towards, which is tapering, pausing, and eventually cutting. Those are the factors to watch. But energy is also part of the reason why we're seeing a pause today. Oil prices have come down meaningfully from their peak. And even though they've also come off the bottom, they're still trading in, I would call it like a mid-range, and they're still actually down year over year. So when you're making a comparison on year over year prices, they're still sort of deflated from that time period. Natural gas fallen off a cliff. In the Bank of Canada's monetary policy report that they released along with this most recent interest rate hike, they're also very specific about what's creating less inflation, which is supply chains improving globally. Yeah. And obviously that also speaks to the China story. So China's probably also one of the Chinese reopening is also one of the themes that we'll have to be watching out for to understand where short-term rates are going to go.
Yeah, I mean, the trends are there, which is nice, and we hope that they can continue, because if we get that, for lack of a better term, immaculate disinflation, effectively meaning a perfect scenario of continued trend towards that 2 to 3% inflation rate target that the Bank of Canada has, then that's great. That means we can follow that down with bond yields. I was reading earlier that the US, if they go with a 25 basis point increase to their rate territory, they will now be in real rate territory for the first time in 2-3 years, something since like 2019. And real rates, meaning that the interest rate or the real interest rates get above a certain measure of core inflation. That is what really puts downward pressure on those inflation readings. And then month over month, as rates stay above inflation, you do typically see it do a great job of moving that down. That's really an ideal scenario. And the faster that happens, the less economic impact there is, the fewer companies have to, start to lay off employees, the better the overall scenario. I guess what we're likely to see from that is, as those rates fall and as that expectation that inflation continues to move down occurs, people will start to come back for home buying.
Yeah.
So,
In fact, we got out of the US on January 27th. We got the personal consumption expenditures, which is actually their preferred metric for how they look to see where inflation is headed. It actually came in just below 4%. The federal funds rate is sitting at 4.25. Another meeting coming up on January 31st. They're widely expected to raise another quarter percentage point. That'll bring it to 4.5. The federal funds rate is sitting above the personal cost expenditure. So we're now in that place where typically inflation would continue to taper from here, because borrowing is now more restrictive than the inflation that we're seeing in the market. Not on a year over year basis, but on a month over month basis, and even over 3 months annualized over a year.
Well, and the month over month data is so much more important. I mean, we can't go back and undo the rate at which things were rising, in the summer of 2022. And we were seeing some incredibly high month over month figures. We know that going forward, the year over year numbers are really just a summation of the monthly changes that we've seen. So as we continue to see month over month data improve, or in that roughly annualized figure 2 to 3%, that's all exactly what we're hoping to see. So that's going to go a long way to make sure that those numbers continue to come in. The other thing is too, that headline inflation, which is your overall basket of goods, including energy and food. Stripping out energy and food, the numbers look so much better, and energy and food can continue to be volatile. I'll strip out shelter too. And we know shelter is a super laggy indicator of inflation. So you take away shelter, energy, and food, which people always ask why you do that, because that's majority of your consumption, and it is true. It's just the volatility of those are pretty substantial, and the volatility of them impacts that overall number as to how fast things are rising. The better measure of actually how fast things are going is to the lower volatile or the less volatile items. The more volatile the item, the more likely they are to also come down as things improve. So the idea is that oil prices do go up, they also can come back down. And as long as overall trends are in line for the remainder of the basket of goods, then that gives the Bank of Canada and the US Fed the opportunity to bring those rates back down. They're more worried about core inflation than they are headline, which there's some silver lining to that.
Yeah. Dev, I also hear, particularly online, like you look around, there's this prevailing narrative that Tiff is making a mistake at the Bank of Canada, because now we're going to be importing inflation as a
Yeah.
result of the US Fed and their trajectory towards a 5% federal funds rate. They're currently at 4.25, which means by the time they got there would be 75 basis points, no, sorry, 50 basis points behind the curve, and that would destroy the Canadian dollar versus its US peers. Those narratives fall apart very quickly. Half the Fed's agenda is the tough talk that they give us every time we have an FOMC meeting, or they release a monetary policy report, or they're just doing media runaround, which seemingly happens every few days from a different member of the Fed committee.
Yeah.
That's half the job, right?
Yeah.
Constraining consumer sentiment typically results in less spending as people anticipate higher interest rates. We're seeing that real consumption is falling. There's a lot of leading indicators that are showing that GDP, particularly stripping out certain elements like inventories, is materially slowing down. Higher interest rates are doing their job. I don't know why there's this prevailing narrative among folks that we should raise rates into perpetuity, irrespective of the consequences. And I only see people quoting this year over year headline inflation figure, as opposed to month over month data, 3 months of the most recent inflation data.
It's easy to speculate. I mean, with like a lot of people that we talk to, whether it's friends, people our age, they're frustrated at trying to buy a home, and not everyone has the bank of mom and dad for gifts or the ability to save up, material amounts of savings to throw at the stock market, early in their career to double their money 10 times, like we all want to do, before you can try and buy a home. So we know unaffordability is super high, especially in and around the GTA. Um, and it does breed a hope for prices to crash, because it is frustrating to watch affordability of of the dream single family home run away from you. It's also what we grew up with, for the most part, experiencing a relatively comfortable lifestyle where our parents weren't forced to put every dollar that they made into affording a family home for us. So I can understand the frustration, and I know a lot of that where it comes from. I mean, I go through bouts of it myself when I'm looking at home prices, thinking there's no way I should be paying this for what this for what this product is, or what this house looks like. It's the same kind of, it's such an understandable frustration, and rising interest rates or rising inflation provides an opportunity for that sentiment to become so much more prevailing, because you now finally have an expectation that housing prices should come down. It's all a discount rate. If your cost of borrowing is much higher, you would pay less for that same asset. So it's something I'm surprised that we haven't seen more of, which is really, price declines of real estate,
Right.
especially in the GTA or downtown Toronto. You're seeing it propped up, or kind of kept in line with low levels of supply. If
Particularly
what
at the
we
lower price points.
Oh, especially at the lower price points, because
Yeah.
there's so much demand, right? We all want
Yeah.
that first property, and you can only live for so long in a condo, whether it's one bed, two bed, especially if you're starting to have kids and you want to grow a family. There's people just need space. More and more people are working from home. You can't both be working from home if you're in a partnership, without being on top of the other, right? You can't have a call and the baby's crying in the back. Not the
Yeah.
easiest thing to do. So
Yeah.
yeah, it's not at all surprising. I don't think it's
Yeah.
understandable, but it's also something that may not actually occur, especially if rates fall sooner rather than later. The housing market is likely to kick back off, and that's just because there is that pent up demand. You have huge amounts of immigration coming in, and the majority settle in Vancouver, Toronto, or Montreal, and it just becomes it's back to that same kind of rat race. Is all right. Well, how do we keep up again? So we
Yeah.
want to we want to set expectations for what people are doing, but also the expectations we have for ourselves. Because you can't just sit on the sidelines hoping for things to fall. Nothing falls in perpetuity. Nothing, just like nothing goes up in perpetuity. But
Yeah.
there's always a ton of demand factors in and around those major centers in Canada that
Yeah.
are going to prop property values up. It's just a
Yeah.
reality.
Yeah. You kind of started this discussion. I'll carry it forward a little bit more, which is, what direction is housing going to take in the near term? And let's not speculate too much about any potential future rate cuts. Let's look at the now, where we have a rate pause and 5-year, 4-year, and 3-year rates are coming down. 2 years kind of stagnant. The stock market started to take off. As yields fall, bond prices have recovered a little bit as well. The bank of mommy and daddy is feeling a little bit more liquid these days. The labor
The good
market
old
is
wealth
still
effect.
very strong. Ah, the wealth effect. It's
Yeah,
incredible.
gotta
In a
love it.
separate episode, we'll get into the discussion about what the pass down of household wealth from the boomer generation down is going to mean moving forward. We won't go too deep into it right now, but as things stabilize, stock market recovers, bond prices recover, labor market continues to remain strong. It's very easy to see an environment in the near term right now where down payments will become more accessible, gifted down payments will become more accessible as things have stabilized. If we don't see a massive fallout in the labor market, which it looks less and less likely that we will, it's very easy to see home prices, particularly on the lower end of the spectrum, stabilize and possibly recover, maybe even take off in the near term. Hard to see a sustained downturn with this pause in rates and with the labor market being as strong as it is, but that's just my 2
Yeah.
cents.
Yeah, no, it makes sense. I mean, the question is ultimately going to be how long do rates stay at this level? And
Mhm.
does inflation follow the expected path or does it reaccelerate? If
Right.
it does reaccelerate and more in line with how housing typically rises and falls is a nice little step pattern. Nothing goes down in a straight line. It's going to take its steps down. So as housing prices stabilize at this level, if inflation starts to run up again, rates start to move up, then we could potentially expect another leg down in housing, especially if that means that more and more current homeowners are pushed to limits for carrying costs, things like that.
Yeah.
But yeah, for buyers that are out there and sitting on the sidelines hoping for prices to drop, I can't say enough that that's you probably want to move when the timing is right for you as opposed to playing the
Yeah.
market because there's no getting it right 100% of the time, and you're more likely to get it wrong than you are
Yeah.
to get it right. So now's the time where rates have stabilized and in fact they've dropped materially. It's a great time to get a rate hold for that spring market. They are still anticipating a rise in supply of housing, which is great. We want those numbers to come back, and it's better to be prepared with a good rate, protecting your upside rate risk if inflation does reaccelerate, so that you
Yeah.
can make the move when you need to.
On that note, if you want to touch base with us about a pre-approval or any other questions, check the description below. You'll see the Calendly link and you can book a time with Devin and I. That said, thanks so much for tuning in. If you've liked this video, please hit the like, subscribe so you get these videos in the future, and we'll see you in the next one.